All right. Shrinkflation is the word where you don't reduce prices but you reduce the quantum. That's because the affordability is a function of the price you pay, which is that you reduce the size of shampoo, you reduce the number of biscuits which you have in a biscuit packet, you just cut those edges, which in a sense the consumer does not really realize. Pankaj Pandey joins us. Let's take our conversation forward. Pankaj, good morning. Thank you for joining us.
Good morning, Nikunj.
What are you telling your clients? How should they ride the storm?
So, Nikunj, I think domestic macros are still sort of good. Even corporate earnings, what we witnessed last quarter, were quite okay. In fact, we have a 1% EPS revision. But I think global macros continues to be very volatile, even with the Fed policy, while the volatility has sort of come down. But till the time your energy prices, especially crude, does not come down, we would not expect a meaningful bounce in the market. So I think what we are advising is to sort of stay on the sidelines. I think SIPs can continue because it's a good market for averaging, given the fact that there is a decent amount of cut across sectors. But I think till the time volatility does not subside and especially crude does not come down, I think probably it is still sort of difficult to sort of catch a falling knife. So which is why we are sort of advising clients to sort of stay on the side.
Okay. Let's start with the mood point, and the mood point is get out of commodities, get out of metals. What is your view? I mean, metal stocks were the real star stocks of 2021. Given what is happening on the macro level, are you telling your clients to get out of metals?
Not at all. So while, say, for example, in metals, if you look at a steel as a segment, where there is a decline of about 15,000 rupees per ton in terms of prices. But I think coking coal prices will also sort of come down, and we have seen a good amount of crack there. But I think aluminum as a space looks a lot more better to us, especially a company like Hindalco, because our sense is that aluminum as a commodity is expected to remain in deficit, and which is why Hindalco relatively is looking a lot more better. But having said that, I think the bigger impact will be when the China sort of normalizes, because we are still sort of skeptical in terms of how China would pan out, given the fact that we have fresh cases of COVID sort of coming up. So till that time, challenges are going to be there. And I think on the export duty, our sense is that while these are measures for inflation, but these are not longish measures, and which is why probably as and when the government realizes that the inflation is under control, I think these measures will be taken back the way it happened in 2008. So we might see a good bounce then, but I think till the time China does not sort of normalize, I think metal in general will continue to face a bigger brunt compared to the rest of the sectors.
Let's get in some views on the charts then, and wanted to discuss two stocks with you, Kunal. What's the outlook on Delta Corp? Because Rakesh and Rekha Jhunjhunwala have further offloaded stake now to 75 lakh shares as on June 22. And what's the view on the reading on Tata Communications after they came out with their ambitious growth plans?
So, for Delta Corp specifically, I believe the chart prospects are still not very attractive because, the recent correction the stock has seen from 340 levels to, I think yesterday it hit a low of I think 175 and then 74 approximately. So it's almost halved from the 340 levels in just about the last 2 months, and that's a very sharp and a steep correction. And we've seen historically as well for Delta Corp that whenever the stock gets into such a sharp periods of correction, it gets into few weeks, few months of sideways price action, and then the stock reverses back and then trends on the lower side yet again. So would not be too much enthused into buying Delta Corp at current levels. Even the F&O positioning, the cash positioning are not positive signs for the stock over the near term. So we'll probably expect the stock to drag a bit more low from current levels, or if it gets into a rally phase, that could be a good opportunity to create fresh shorts in a stock like Delta Corp. Tata Com on the other hand, I think is now getting back into a deep oversold territory on the charts. So yesterday the stock managed to make a fresh swing low. I think closed at 870.75 on the spot levels on the back of some very high volumes. But then the stock is divergence by almost 50% from its 200 moving averages. These are steep divergences for a stock like Tata Com, and typically those become very good entry points for contrarian traders. So I think for Tata Communications specifically at current levels, I think should be a very good buy, specifically given the kind of divergence the stock has shown from its 200-day moving average.
Okay. Suresh, has Bajaj Finance seen its corrective move? A 8,000 rupee stock almost came to 5,000 and then it has seen a meaningful bounce in last 2 days.
So I would say it's not over as such till the time we are back above the 6100 mark. So for now it is possible that we are oversold and we could get back to a bounce back from the oversold zone. So and get range bound. So for now I would expect a move towards 5900 to 6100 on the upside. But that does not imply the correction could be over. We could again go down and then sideways. So for now, my expectation is we are getting into a range bound move. It's a bounce back trade. One has to take it with the strict stop loss at 5400 and look to get out at 5900, 6100. For now, I think it should be range between 5400 to 6100.
If you were to see, the volume buzzers yesterday accompanied by a price action too, Bajaj Finserv is one, and Naresh, the other one is Tata Motors, which was up by nearly 2% yesterday. You also saw some Hero Motor smart moves. M&M didn't see that kind of a smart move yesterday. What's your call on these three stocks?
So if you look at it, the Nifty auto stocks itself, this is one sector in which many of the names are higher than the say February highs and much higher than the lows from the March levels. So clearly the sector has become a leader. In that, Tata Motors has not taken that uptick in a sharp way as the rest of the names have. But if you look at Tata Motors, the stock has not corrected much also. So from a high of 450, say 450 to 460 in the last 3-4 months, the stock is down to 410, 420. That's not even a 10% correction given that what has happened with the markets. Stock technically is range bound between 370 to 450, 460. I would actually be looking out for, say, whenever that breaks out above 450, it would be a strong trend. So overall longer term trend is still positive, but we are yet to see that breakout move. It's consolidating. Then if we next go to Hero MotoCorp, the stock is very interesting if we look at it from a longer term perspective. Two reasons for it. The stock has been a major underperformer. So when I say major underperformer, the stock is available at the same prices as it was in 2014 levels. So it's basically 8 years of no returns and only just dividends. In the short term, a classical double bottom made at 21.15. Higher tops, higher bottom formations have continued. Pre-Russia Ukraine, the stock was actually trying to make a breakout move about 2800, 2850. The same was a resistance a few weeks back. Now you started making a base at 2500. So slowly and steadily, I would expect it to first go towards 2800, 2850, and then review if that breaks out. We could go much higher. So technically setting up for some bit of outperformance after multi years of underperformance. Same if you look at Mahindra and Mahindra, not seeing much of a move, but if you look at it, the stock is just 3-4% away from an all-time high, which it made a couple of weeks back. Also, the stock was at say closer to 850 to 900 back in January to Feb 2022, and it has done really well in relative sense. In the little longer term, if you look at the last 4 years, the stock topped out back in 2018 at 950, 980. The same levels of 950, 980 got tested almost 4 times in the last 1 year. And finally, the stock has clearly given a breakout above those zones. So structurally, one of the best looking charts in the large cap category. So I would expect this to slowly go towards 1500 levels in the next, say 1 to 2 years, or could be faster also. So structurally, extremely bullish on Mahindra and Mahindra, and stick to the view which has been for quite some time that Mahindra and Mahindra is the best bet in the auto sector.
Okay, right now trading a little above 1,000 rupees a share, Mahindra and Mahindra. Pankaj Pandey, if I can come to you now. Reliance Industries for the year, higher by 17%. There is now consensus building that this stock could hit, 2,900, 3,000 rupees a share, and that's, an 11% upside. What's your outlook when we talk about Reliance Industries?
So I think Reliance is benefiting from this current sort of volatility, especially given the fact that the GRMs are still at elevated levels for this quarter. The GRMs are at about $20 per barrel, especially Singapore. So obviously that segment for Reliance is expected to do well in this particular quarter. We didn't see that kind of a bump up last quarter. Similarly, gas production also is expected to sort of get ramped up and will reach about 30 MMSCMD. So that and also gas realization is expected to be higher. Telecom business continues to sort of do well, and on the retail side, I think this is the first time they've crossed lakh crore kind of a sales mark. And again, expectation here is that when you talk of most of the retailers, the pre-COVID recovery has been pretty good. So we are expecting about 25% kind of a CAGR growth in the retail and 40% kind of a CAGR in EBITDA. So overall, I think company is in a sort of sweet spot whenever you look at most of their business segments. So we have a positive view on it, and I think Reliance overall has been sort of supporting the market compared to the rest of the tier one large caps. And I think we should stay bullish on Reliance.
Looking at a couple of events today, and well, of course, the big event is how the global markets and us are going to react to that Fed rate hike. But in the meantime, you've got Ather Industries as well coming out with its numbers today, and I think it's the first after their listing. The entire newly listed startup space, of course, has been under scanner, and while Ather, of course, may be an exception both on its listing as well as how it's performed thereafter, many other names have seen a hard beating. Pankaj Pandey, from Policy Bazaar to Paytm to Zomato, have you been a buyer or recommended a buy anywhere after the recent correction?
Actually not. So I think this entire new listings are still sort of looking on an expensive side. And in some of them, we are still not very comfortable in terms of how they're going to make profit. And most of them are trading in excess of 10 times sales. So a combination of these factors, along with the kind of volatility what we are seeing, I think we are still not bullish on some of these names. We are still not sort of tracking very actively. Coverage is again sort of a next leg, which again will take time. So at this point in time, we are not really sort of tracking any of the new listings because our sense is that even with the correction, the valuations are still on a higher side compared to listed space where we have at least a decent predictability of turnover and bottom line. So I think I would still not be really chasing these newly listed ones for at least some period of time.
The delivery based numbers, and one stock which in a sense is standing out of the big stocks where the delivery based buying is strong is Trent. To give you a backdrop here, Trent is a Tata Group company. They own Westside. They have a joint venture with Zara here, and they also have Star Bazaar. The interesting bit here is that Trent is outperforming when other retailers are getting smoked. So look at DMart. DMart is almost down 50% from its high. Aditya Birla Fashion Retail, it's down in a tizzy. Urban Fashion, that has not done exceedingly well. But Trent is an expensive stock, and an expensive stock outperforming in this kind of a market, when in general there seems to be a scramble, I think is quite extraordinary. Now that's yesterday's change. Look at the YTD change in, let's say, an Avenue Supermart and a Trent. Look at the 1 year change in an Avenue Supermart and a Trent, and you will see a strikingly large difference here. There's a green and a red. So Avenue Supermart in 6 months is down 22%, expensive. But Trent is also down, is up 6%. So look at the divergence here. Pankaj, when inflation is here, value retail will do well. Sasta Sundar Tikau, right? That will do very well when you are feeling the heat of inflation. Then shouldn't a stock like DMart be outperforming?
So I think so. Obviously, valuation wise, obviously it's been expensive, and then I think what we have seen is that when you sort of look at some of the categories like say FMCG, I think that is where probably the recovery could take a bit of a longer period of time. Overall, company has been sort of doing a lot more better, so there is no sort of letdown in terms of overall growth or the store expansion. But yes, you're right that both the companies are expensive. Somehow DMart has taken a bigger sort of a beating compared to say Trent. But from a number perspective, we haven't really sort of revised downward numbers for both the companies. So I think retailing is something which is looking or looking better, lot better from an organized perspective, because I think when you look at a big market like US, retailing in terms of market cap also is commanding double digit. In India, it's hardly 2-3 odd %. So from that perspective, retailing looks a lot more better, especially the apparel, and which is where I think Trent is sort of looking a lot more better. And I think most of your retailers, if you look at, are looking to sort of double the kind of space addition compared to what they have done in the last 3-4 odd years. So despite that, Trent continues to do well. Demand, despite decent set of numbers, has taken a bigger sort of a beating. So retailing obviously looks a lot more better compared to the other, but I really do not have very exact reasons why demand should have corrected.
Fair enough. That's the view coming in on the retail space. But let's also, as promised, share some top fundamental stock ideas. Hear it out from Hemant Jani as well as Deepan Mehta.
Adani, I think very difficult to make a call because that company is not that well discovered in terms of the research, in insights or the kind of general information which is available in the public domain. So we don't have much insights into it. And of course, if you have a major news that some MNC company is going to pick up a stake, and to that extent the valuation can get a little better than what it is right now. So it will completely depend upon the news flow, and we think that in a market where most of the large cap names have corrected, let's say about 20-25%, mid caps have corrected more. The appetite to go in for names where the stocks have really run up, let's say 3x, 5x, 7x, and where you don't see much clarity on the earnings, at least in the near term. I don't think that there is an appetite and a sentiment in the market to chase these companies. So we would stay away from these names at this point of time.
You have to look for companies which have a slightly differentiated business model, or which are focused and derive a large portion of the revenues from the domestic market. Because the domestic pharma market is doing very well, revenues are growing at a fair clip, high, I would say double digits or thereabout. And the threat of pricing, price mechanism, that's NELP pricing, has gradually reduced because inflation the way it is, that a lot of that inflation is being permitted to pass through for the medicines where there is price control. So on the whole, the dynamics for companies supplying to Indian domestic market are excellent. Keeping that in mind, we like companies like Eris Life Sciences, which are totally focused on domestic market largely. Alchem Laboratories, another company, again disclosure, we and our clients are invested. And then we are looking for businesses which have a slightly differentiated business model in the sense that they engage in contract manufacturing.
IPL has made a lot of headline, and all kind of comparisons are there as to how much money has been paid for IPL rights. What is your view? I mean, what is the best way to capitalize on this entire IPL rights? Is it a good time to let's say buy into a media company like TV18?
The question is for me?
That's right, Pankaj.
Yeah, so I think the only beneficiary, according to us, will be USL. Sun is something where we are not very comfortable given the fact that despite the decline in profitability, the promoter salaries are still at elevated levels. Now, I think for the companies who have sort of won the rights, we are still not very clear in terms of how they will sort of make money. It could be a sort of a winner's curse kind of a scenario. So, which is where I think according to us, the only beneficiary would be USL, which again is sort of shifting their portfolio towards a premium side, and overall, I think that is the only beneficiary which I see. The rest of the other companies, we still are not very clear, given the fact that one of the biggest advertisers, like say FMCG, I think, and the overall challenge what these companies are facing, we may not see an elevated level of spending coming from them. So higher ad rates, how would that sort of percolate? We still don't have an answer for that. But I think of the overall USL looks a lot more better. So I think that is the only winner in this case.
Couple of other breakout shares, and just take a look at the trading structure yesterday. Some of the gas names did very well, and IGL clearly was one such case in point which actually managed to hold out on the gains. Both IGL, MGL as well as GAIL, all of them participated very well in yesterday's session. But at 355, Kunal, you think there's further headroom in IGL?
Well, we'll wait out for maybe a couple of days, Aisha, because the stock has been showing absolute signs of weakness on the charts. Now, when you look at the last 5-6 months, IGL I think at the start of the year was closer to 500 odd rupees. From there, it had corrected sharply to almost 325, where it bottomed out first the month of Feb and March beginning, and then from there it's trying to grapple into getting into a trading range, but then it's not finding its feet that strongly. It's in fact, even in this consolidation, it's making a pattern of lower highs and lower lows. So we'll probably wait out for some more time for IGL to try and stabilize, or at least the stock to try and show signs of reversal where it breaks out of its resistances. This could be yesterday's move could probably be one-off day move for IGL, but if it breaks past about 375, this move, if it takes the stock higher than 375, then we can establish that this could be a strong trend reversal move. So we'll wait out for at least another 20 points higher from current levels, and once that happens, then the potential upside for IGL above those 375 levels could be as much as even 425 as well. So we'll wait out for the first 20 bucks and then look out to buy IGL above the 375 mark.
Okay, I want to look at the traders setup once again, just to establish for the benefit of our viewers, those who've tuned in. Fed has increased rates by 75 bips. On expected lines, Fed has exactly given markets what it wanted, a firm commitment that they are at war against inflation and they will do whatever it takes to crush inflation down. That's what you want to hear, because Fed in a sense has lost a lot of credibility in predicting the inflation curve. So markets have got what they wanted, a 75 rate hike, and the door is open for a lot more is coming. We are seeing a lot of green on the screen. That could be also a relief rally, because markets were oversold. US markets have been in a tailspin, and somewhere the dollar positioning in a sense was not in favor of emerging markets. But will markets give Fed what it wants, which is stability and less volatility? That's very difficult, and that is going to be very, very data dependent. The good thing is, let's put the Nifty chart that at 15,700, 15,800, call it the Lakshman Rekha. A lot has been thrown at the market in last 2 months, but we managed to magically bounce back again and again from those marks, and today there is reason to believe that we are likely to gain some more elevation. That is how I would like to describe the trade setup, but I don't think we are out of the woods. So to assume that okay, 75 whips rate hike and event risk is behind us and we'll be off to races, I think would not be a good idea. You still got to be humble and nimble in this kind of market. There you go. June 2021, same support, and a multi I would not use the word multi support, but I would say that a recurring support or a firm support at 15,700, 15,800 magically seems to be coming back. Pankaj, I'm going to shift gears and talk about a stock which FIs first they adored and now they are throwing it away. That's HDFC Limited. Is this the overhang of the merger which is forcing them to sell?
So obviously, yes, when you have a developer book of say about 25-30,000 odd crore, I think that needs to be sort of do away with for merger to happen. And I think when HDFC gave a sort of outlook of 15% kind of a CAGR growth, I think that is again sort of a bit lower compared to what they have grown historically. So combined basis, it doesn't really sort of enthuse the market. Including us, and I think see till the time FI selling continues, the entire BFSI or even the IT as a pack, despite decent risk reward ratios, despite decent growth outlook, is not expected to perform. I mean, unlike when you look at say capital companies, these are not heavily owned by FIs, but here if you look at the price performance is relatively lot more better when you look at bearing companies. Or you have other companies like say LG or so there are a number of companies on the capital goods side which are sort of doing relatively better just because of the fact that they are not heavily FI owned. So I think it is the FI selling which is having a bigger impact despite decent sort of growth credentials for the entire BFSI or IT space.
Right. Okay, Pankaj, stay with us. Lots more to talk about as we move closer to the market open. In fact, the pre-open rates itself, which should have a positive start for us. But in the meantime, let's detour a little bit. Let's tell you what else is happening across the nation. Okay, that's a slice of what else is happening outside the world of business, but getting set for the pre-open rates. And while yesterday we managed to defend that 15,700 print, let's see what we do today in line with the rest of the globe. I just want to in fact mark what Asia is up to, about 1.5% up in the green for Japan. You're holding mildly in the green for Shanghai, but Shanghai, remember, all through this week, in any case, has outperformed the rest of the global markets. Hong Kong flat. But yes, positive moves for both Korea as well as periphery markets like Australia. In the meantime, let's also get your status check on what the US futures are indicating, although it's a little too early, but they're still holding out well in the green, about a 200-point move on the Dow futures, 0.6% higher for S&P, and the Nasdaq futures as well as scaling higher smartly. So it seems that the rebound, at least for US equities, should last for some more time to come. But that said, Kunal, just wanted to understand where would the leadership today sectorally going to come in from in this today's rebound, or do you think it's going to be more across the board?
I think I would probably prefer more across the board, Aisha, because the last couple of days we've seen a lot of mixed signals coming back from the indices. Bank Nifty was not as strong as what was perceived to be. Auto stocks remain to be more of a stronger pack on an overall basis. You didn't see any major short covering coming across into the ITs, the metals, etc. Even the CPSE index or the PSU stocks, they also managed to slightly underperform or not show any major signs of trend picking up. So my sense is that I think the first half at least could be more broad-based, where you could probably see many sectors participating, individual stocks participating. Reliance, I think, could hold the key for the markets as well over the near term. If that stock manages to recover and rally back above those 2,700 odd mark, then I believe the confidence should get a bit more stronger for the indices. But net, I believe today could be a day where we may start to see some sort of a patterns emerging from stocks as well as sector specific trends. Auto stocks is the auto sector is the only one which is now looking as a more stronger sector. But I think if the banks also manage to see a round of short covering, then it could probably get back into that line of being a stronger and resilient sector, and probably try and cover up the underperformance which it had shown in the last few days.
Right. Okay. That's where leadership signs should come in from, and Kunal surely hopes that it should be across the board. Pankaj Pandey, any other interesting buy ideas that you've picked out for your investors?
I think at this point in time, largely if you look at probably capital goods and auto sector is sort of looking decent. I think auto, if you look at CV, despite the fact that we are expecting about 20-25% kind of a growth in CV as a segment, we'll still not see FY19 levels or sales levels being crossed in FY24. So that is one segment which is looking good, and especially you have Ashok Leyland and Automotive Excel is looking good there. And I think the capital goods space, especially bearings, whether you look at SKF or Timken, I think both of them are looking good. I think last quarter numbers were very good, and they're able to sort of pass on the commodity cost. So that is another which is looking good. AI engineering is another company which has been sort of looking good. I think they've given a very good volume growth last quarter, and lastly, our expectation is that volume growth is going to be very healthy. So that is another stock which you have been sort of liking. Then you have companies like Thermax, Siemens, and within defense, I think Bharat Electronics looks good to us.
Let's get in those mid-cap trading recommendations as well. What is it that our chartists are flagging off today? Let's find out. And Naresh, what is it that's catching your eye within the broader universe?
So looking at a buy on Lemon Tree, the stock has corrected well from 70 odd levels made recently back to 60s. Currently, the stock is now still below the pre-COVID levels. From here on, expecting it to slowly go towards 75 again in the minimum case and 90 also in the medium term. A stop loss at 58.
Alright, watch out for Lemon Tree Hotels, target price 75 rupees. Kunal, what's your favorite pick when it comes to the mid and the small caps? What are you cherry picking?
So I would suggest a buy on Praj Industries. I think the chart patterns in the last 2 days, very strong, robust candlestick patterns getting formed for Praj Industries. The stock covering up a gap, resistance, a down gap resistance as well, on closing basis yesterday. And it's also now, closer to its 200 moving average than what was few trading sessions back. So I think on the back of all of this, I would expect Praj Industries to perform exceptionally well over the near term. Would suggest a buy with 346, 350 as a potential near-term target range. Stop loss for the trade 321.
Okay, Pandey, before we let you go, it's a day where we might be watching out more for the rate sensitives also, just given what's happened in the United States. In fact, a lot of the headlines coming in from the US is about how their mortgage market, their real estate market is under threat. Back home for us, in India, it's one of the best comebacks that we've seen of the property market. We're just seeing the way cash holding is right now and the way cash was taken off the table. What would that mean when we look at the real estate stocks as well? We've seen the comeback. We've seen people go back to office. Is this a story you're still convinced about? And then what would be your top picks?
So in real estate, if you look at, there are a number of moving parts. One, when you look at, say, the sales value, it has jumped 50% for top 6-7 odd players. Similarly, the launches have also gone, and in fact, the pipeline for FY23 is also pretty healthy for most of these companies. Now, but having said that, cost inflation is also another factor which is sort of impacting. And largely the impact is in the range of 10 to 13 odd %. Largely companies are stating that they will sort of absorb half of this cost and the balance will be passed to the customers. Having said that, so because of that, we are seeing a sort of a muted performance, a price performance, given the fact that this was one of the best performing sector. Our sense is that one can still look at some of the companies like Brigade or Mahindra Lifespace. I think these are the companies which are sort of looking attractive to us, given the fact that there is not much of a stress what you see on the balance sheet side, and then launches or the launch pipeline for these companies is also good. But till the time there is the inflationary pressure there, we would not expect a broad-based performance from the sector.
Okay, so you're expecting the sector to maybe continue the kind of underperformance that we've been seeing, or rather muted performance, I think would describe it better. Pankaj Pandey, thank you so much for being live with us today and being so candid with as far as your views on stocks and sectors go.
Thank you so much.
Well, ladies and gentlemen, it's almost 9:05 a.m.